All right. So first of all, these are the unknown unknowns that we've been talking about from the beginning of the year, what you can't plan for. Jeff, how concerned are you?
Yeah, look, I mean, the market's not down that much. If you look at the S&P, you're talking about maybe 20 basis points. And the fact of the matter is you can point to any number of measures that might make investors feel like the market's primed for a pullback. So you look at the options market, the put-call ratio is low. I think some 87% of stocks are above their 200-day moving average. So you can point to those numbers. But I was just with clients this morning, and the fact is the next correction is always right around the corner. If you look back over the last 40 years, the average correction somewhere around 12%. We've only finished negative on the year 7 times. So I think for most investors, for our clients, for most people watching this show, you shouldn't really be trading for the next, 10 to 15% correction in the midst of what we believe is a bull market. If you think about sentiment also just quickly, people are trying to make an analogy between now and the beginning of 2018, where we saw that big run up and sell off. I don't think the euphoria is the same. If you look at the largest stocks in the Russell 1000, there were 60% of those stocks were 2 standard deviations above their 200-day in the beginning of 2018. That percentage is below 20% today. Credit's still stable, so I don't think we're in the same environment. Sure, the market could wobble a little bit here, but I think what we're seeing right now with this Boeing news and the news about the virus in China is, it's not as primed as many people might think, because we're only down about 20 basis points.
Brian, it seems to me like the headlines drive a lot of action right away. I mean, we talk a lot about that FOMO, fear of missing out. How much of that comes into play here, and how much of what we're seeing today is fear of taking it on the chin?
Well, I think, again, Jeff was bang on in terms of what's happening on a technical perspective. But the bottom line is, from an investor perspective, you should buy and sell stocks on fundamentals. In the fundamental construct of the United States stock market hasn't changed the last few hours. We believe that stocks are going to be higher a year from now than they are today. Fundamentals drive stocks. And yes, again, stocks are rarely linear for long. Gravity will win at some point. But if you're trying to time the market and buy or sell today, that's not the right way to invest. Now, again, from a fundamental perspective, I think most investors are missing a couple points. Number one, earnings have clearly troughed, and we're going to be seeing a recovery in the next 2 to 3 quarters. Number two, from an allocation standpoint, portfolio managers massively underperformed, including a couple that CNBC has been talking about all day long, Mr. Dahlia and Mr. Tudor. They underperformed dramatically last year. And, oh, by the way, dramatically underperformed the last 5 years. And now we're starting to see people pile into the market because they've underperformed. Again, that's not fundamental, but then again, that's more human nature. Do we think that's a near-term problem? Yes, we do. Do we think the bull market has 10 more years to go? Yes, we do.
I guess I want to go back to, Jeff, if you don't mind. I want to get a clarification on something you said. Did you say that you don't recommend people trade right now? Did I hear that?
Yeah, correct. Yeah, no, that's exactly right. I think, look, for most of our clients who have to think about taxes, number one, and then also if you're talking about a 10 or 15% drawdown, to be able to get in and get out just at the right time, I think ultimately if you think the market's going to be higher 12 months from now, like I do, it probably doesn't make sense to be trading this market.
Well, I also heard Brian say that he thought that the earnings had troughed. Is that right, Brian?
It is.
Where did you get that from?
We get that from, number one, the secular trend. You got to remember the last 10 years that companies in America have underpromised and overdelivered. If you take a look at revisions heading into earnings revisions on the next year out number, they bottom and are beginning to recover. Number two, the economy clearly is in very good shape, and we think that's going to continue to drive things. And oh, by the way, too, once we get this phase 2 deal done, the USMCA is done, I think we're going to see the semblance of some sort of CapEx for the first time in 20 years in our country, and that will also help levitate some earnings expectations that we think are still too low.
So since we've got a real-world business person here, your company's stock had troughed and has come back very nicely over the past 3-4 months, right?
It has.
How about your business? What is the earnings arc look like there?
Now, you know me that I'm not going to talk about that, but what I will talk about is the trough and the peaks and all these different movements in stocks are also attributable to the decisions that we make as business leaders. And I made a bad decision, which took my company down, reversed that decision.
What was it?
I decided to get into a retail space that I probably shouldn't have gotten into. Early course correction, and you see the rebound. But when we talk about the actual earnings improving in 2020, we're making the assumption that the consumer has also returned to a regular spending pattern in lots of different areas, and that CapEx, as he pointed out, is going to continue to get stronger. I'm not sure where people are gathering that information from, because I do think there's companies starting to build their balance sheets with cash and not have everything just leave.
All right, final question, Brian, if I might. You said earlier, and I agree with you on principle, that timing the market is a bad idea. But is there a place in a market like this for dynamic rebalancing of your portfolio if you did so well in 2019 and in this first month of 2020 that now your equity portion is higher than you want it to be?
Well, I think a great way to provide income for your portfolio, quite frankly, Tyler, is dividend growth in terms of equities. And equity income, I think, is a discipline that dramatically outperformed last year. But when you take a look at private client money in North America, it's still woefully underweight in the value category, in the dividend growth category. So I think those areas that have seen dramatic upside, like a lot of the growth stocks last year, we could see some rotation back into the equity income sleeve and provide income for those customers and clients that need that.
So don't necessarily move out of stocks, but maybe change the kind of stocks you own.
I would definitely do that. And remember, too, sometimes in life we make binary decisions, either buy or sell, growth or value. I think most people are not as diversified as they should be in terms of equity income and value in particular.
Right.